Thank you, Stephen. Good evening and welcome, everyone. We are here to discuss Pnb Housing Finance Q2 and H1 Financial Year 1920 results, adopted as per Indian accounting standards. With me, we have our leadership team, represented by Mr. Sanjay Gupta, Managing Director, Mr. Shaji Varghese, Executive Director, Business Development, Mr. Ajay Gupta, Executive Director, Risk Management, Mr. Anshu Bhargava, Chief People Officer, Mr. Sanjay Jain, Company Secretary and Head of Compliance, and Mr. Kapish Jain, Chief Financial Officer. We will begin this call with the overview and performance update by the Managing Director, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual development and results to differ materially from our expectations. Pnb Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 2 of the investor presentation available on our website. With that, I will now hand over the call to Mr. Sanjay Gupta. Over to you, sir.
Thank you, Deepika. Good evening, everyone. Welcome all to our Q2 and H1 Financial Year 1920 earnings call. You must have seen our business and financial numbers in the presentation and the press release shared on the Indian stock exchanges and is also made available on our website. In this call, I would like to spend more time talking about both qualitative and quantitative aspects of our business, on assets under management, liquidity position, and capital raise. Despite the challenging environment, the company continues to mobilize resources from various sources like bank term loans, ECB, deposits, securitization via direct assignment route, etc. Numerous measures announced by the government and the RBI has adequately helped in infusion of liquidity in the sector and reposing confidence. The company incrementally mobilized 45,000 crores post the liquidity crisis of September of 2018. That is over the last 4 quarters. The company enjoys a very strong deposit franchise, supported by highest rating of FAAA for deposits from CRISIL Limited, and is the second highest deposit mobilizer in the HFC sector. We mobilized more than 1,000 crores and acquired over 17,000 deposit accounts in the month of September 2019, growth of over 2.5 times from September of 2018. These deposits are sticky in nature with tenure ranging between 30 to 36 months and renewal rates of over 40% by value. Deposits as on 30th September 2019 stand at 17,179 crores, that is 20% of our total financial resources. With 15,108 crore of securitized book as on 30th September 2019, the company has developed expertise in securitization through a direct assignment route. As on September 30th, 2019, our securitized book is of 36 months vintage with gross non-performing assets of only 0.19% or 19 bips. With an objective to contain gearing, the company securitized 3,580 crores in Q2 of the current financial year. With our continued focus on the long-term borrowing, securitization and sell-down of corporate finance assets, the ALM gaps across buckets have further contracted. The negative balance of 1,959 crores in less than 12 months window as of 31st March 2019 reduced by about 30% to 1,371 crores as on 30th September 2019. RBI's announcement of raising the limit for on-lending of housing loans up to 20 lakhs to be qualified under PSL is another beneficial move for the company, as around 20% of our individual home loan falls below the 20 lakh bracket. On our resource profile, 22% is contributed by non-convertible debentures, 22% by banks, 20% by deposits, 17% by direct assignment, 8% refinance from the National Housing Bank, NHB, and 6% through external commercial borrowings, and 5% are the commercial papers. The company has raised ECB of $175 million from multilateral institutes like IFC Washington, D.C. and multinational banks like SMBC, reposing their faith on the operational robustness of the company. The company has maintained adequate cash and liquidity investments of 4,557 crores as on 30th September 2019. Additionally, the company has healthy pipeline of sanctions from banks and financial institutions. On capitalization front, our CRAR as on 30th September 2019 is at 15.67%, with Tier 1 at 12.69%. This has improved from CRAR of 13.98 with Tier 1 of 11% as on 31st March 2019. The improvement is primarily due to the reduction in corporate loan book and securitization of our retail assets. Please note that the CRAR numbers are as per IGAAP, net owned funds, and does not consider the positive impact on net worth arising out of Ind AS adjustments. The average gearing of the company is at 9.2 times during H1 of financial year 19-20, which has improved from 9.3 times during financial year 18-19. As on 30th September 2019, we have assets under management of 89,471 crores, retail assets of 72,595 crores, constituting 81% of the AUM. We continue to focus on building our retail book during the year. Geographically, West is our largest market with 40% of assets under management, followed by North and South at 30% each. We have limited presence in East with 3 branches, 2 in Calcutta and 1 in Bhubaneswar, which forms a part of the North Zone. In our retail segment, which comprises 81% of the AUM, individual housing loans constitute 59% of the AUM. Retail loan against property, that is retail loan LAP, constitute 18%, and retail non-residential premises loans are at 4% of the AUM. In the individual housing loan segment, funding towards completed properties is around 79%. Even on incremental disbursement, the individual housing loans disbursed in H1 of current financial year under the APF category is lower by 21% compared to H1 of the previous year. Our retail LAP segment consists of loans primarily disbursed for working capital to the SME customers. Our LAP book has an average ticket size of 47 lakhs with loan to value of 50%. Majority of our LAP customers are credit tested with average monthly income of 2.1 lakh per month. LAP portfolio includes 82% of self-employed customers in the age bracket of 40 to 55 years. There are queries raised around the average ticket size of the retail book. The company is into mass housing and over 75% of its retail loans are under 1 crore rupees. In our retail loans, only 20 accounts are with an average ticket size of over 15 crores, which is just 0.6% of the retail assets with nil NPA. You may also refer to a detailed slide on this shared on our investor presentation. The corporate loan book as on 30th September 2019 is 19% of the assets under management, down by 1% on a sequential basis. This constitutes 12% as construction finance, 4% as corporate term loans, and 3% as lease rental discounting. Our lending in this space is primarily to marquee real estate developers and repeat customers. During H1 of the current financial year, the corporate book witnessed natural runoff of 6.33%, excluding a sell down of 842 crores, which was in LRD. As on 30th September, corporate book is spread across 156 unique developers, down from 163 as on 30th June 2019. Construction finance is spread over 118 developers and 158 residential projects. Our funding in the corporate loan book is primarily to the projects that cater to mass housing segment. As on 30th September 2019, the company has funded over 73,000 units, with 94% of the units having ticket size up to rupees 1 crore and from 1 to 3 crores. During H1 of financial year 1920, principal repayment started in 38 accounts, having total outstanding of 1,492 crores. The amount collected in these facilities during the period is 230 crores. The top 20 developers with 62 loan accounts constitute 62% of the corporate book. In our construction finance book as on 30th September 2019, the under construction percentage has come down to 57% as compared to 62% as on 30th June 2019. We have strengthened our existing teams and created specialized groups of skilled professionals from various streams to monitor, measure, and proactively mitigate risk arising due to the current environment. As informed earlier too, as a part of continuous monitoring, we had identified 5 accounts which were stretched. Initially, when we had identified these accounts, the loan outstanding as on 31st March 2019 was 908 crores, which has reduced by 8% as on 30th September 2019 to 833 crores. On lines of conservatism and as a prudent measure, we have created over 33% ECL provision in these 5 accounts, up from 21% as on 30th of June 2019. In addition to this, we have also increased the quantum of steady-state provision by 12 crores to 169 crores. Out of these 5 accounts, 1 account, that is IDEO Private Limited, with security cover of over 2.5 times, had moved into NPA in Q1 of this financial year. As mentioned in our last earnings call, the developer had approached with a structured repayment plan. As a result, the developer deposited 39 crores, resulting in principal outstanding reduced to 111 crores. We continue to work with the developer on the structured payment plan and expect to resolve this account by the end of the current financial year. The largest corporate exposure of the company is to Lodha developers. The company has given them 2 loans amounting to 1,250 crores for 2 projects, that is Lodha World 1 and Trump Towers. The company is the sole lender in both these projects. We have long-term relationship with Lodha, and these are our 4th and the 5th facility to them. The earlier 3 facilities were either prepaid or timely repaid. Our security cover in these projects is more than 1.5 times, along with the personal guarantee of the promoter. There is no pending regulatory approvals, and construction risk on these projects is next to zero. To boost sales, the developer has undertaken an intense sales drive. With the challenging environment, the company has not only significantly reduced corporate loan disbursements, but has also tightened its lending norms, restructured the entire team, and heavily invested in IT enablement of the workflow to further make operations robust and world-class. We would continue to remain cautious on lending to this segment till we see positive developments and improvements in the sector. Gross NPAs as on 30th September 2019 is at 0.84% of the loan assets. The gross non-performing assets on retail loans is at 0.84% and on corporate loans is at 0.83%. The gross non-performing assets on the AUM is at 0.73% as of 30th September 2019. As a result of effective use of SARFAESI, the gross non-performing assets on sequential basis in absolute terms has come down by 21 crores from 645 crores as on 30th June 2019. In this regard, would also like to mention that the life-to-date write-offs by the company is just 6 basis points on the cumulative disbursements. As of 30th September 2019, our total provisions to assets stand comfortably at 1.2%, and the provision coverage is at 143%. The Board of Directors of the company approved the capital raise plan up to 2,000 crores. The Shareholders Relationship Committee is overseeing the capital raise plan. Today, the board was appraised on the current status of the capital raise. The same is currently under process, and we will come back to the market in next few weeks' time with an update. The board is in synchronization with the management and plan and approach towards the capital raise. The company further strengthened the financial stability. The profit after tax for H1 of 2019 and 20 stood at 651.3 crores as compared to 508.8 crores for H1 of 18-19, a growth of 28%. The spread on loans for H1 during the current financial year is 256 basis points. Excluding the assignment income and other indirect adjustments, that is as per IGAAP, the spread on loans for H1 of the current financial year is 206 basis points. Net interest margin for H1 of the current financial year is 316 basis points. The gross margin net of acquisition costs and including fees for H1 of the current financial year stood at 344 basis points against 319 basis points during H1 of the previous financial year. The OPEX to average total assets or ATA for the financial year, excluding ESOP cost of 16.8 crores being more of an accounting provision, stood at 56 basis points. This includes employee costs of our subsidiary company PHFL, which largely houses the in-house sales force. The cumulative ECL provision as on 30th September 2019 is 725 crores. As a prudent management with the positive impact of corporate tax cut, the company added an additional amount of 12 crores in the steady state provision for contingencies amounting to 169 crores. The return on assets for the period is at 1.58% compared to 1.47% of the previous financial year. On average, gearing of 9.2 times against 8.9 times during the previous financial year, the return on equity for H1 of 1920 is at 16.74% compared to 15.54% for H1 of the previous year. The closing net worth as per Indirect as of 30th September 2019 is 8,035.3 crores. Now let me talk about the business performance. During H1 of the current financial year, we registered a degrowth of 4% in loan file logins compared to the corresponding period of the previous financial year. The disbursements degrew by 31% to 12,604 crores vis-a-vis 18,172 crores during H1 of the previous year. The company during Q2 of the current financial year securitized 3,580 crores of its retail loan portfolio, both home loans and LAP, through the direct assignment route, totaling to 5,898 crores. With consistently superior asset quality and good proportion of priority sector lending, the company's portfolio continues to enjoy a good demand from banks, HFCs for pool buyout. Net of the assigned loans, the loan assets of 74,353 crores as of 30th September 2019, representing a healthy growth of 11% year-on-year. During H1 of financial year 1920, out of the total individual housing loan disbursement, around 28% by value was in less than 25 lakh category, which can be termed as affordable housing. With stabilization of our branch network in Tier 2 and Tier 3 cities, we look forward to growing the contribution of affordable segment in our individual loan portfolio. On CSR, our continuous endeavor under the Saksham program is in line with our philosophy to enable the marginalized community in becoming capable and self-reliant. We work for construction labor skill enhancement trainings, daycare centers, education and healthcare under our CSR program. We are a strong 1,684 full-time employee team as on 30th September 2019. The company continues to maintain a balanced approach to business and growth with focus on asset quality and profitability. With primary focus of raising equity, maintaining adequate liquidity with matching ALM, robust asset quality and reduced gearing, the company expects to maintain the current run rate of disbursement for rest of the financial year 1920 with increased share of retail business. With this, we would now open the floor for questions and answers. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good evening, sir, and thanks for a very comprehensive outlook. Just had a question on the capital raise. That part of the outlook was still not clear in the sense there is no timeline mentioned in when will you raise capital, and we expected that by calendar year 2019 you will be able to raise capital. So does the timeline hold, and what is the amount that you are likely to raise?
See, the amount is 2,000 crores, which is already approved by the board. The volatile external situation has been forcing the BRLMs, the management and the board to keep on changing the format. And I think in a time frame of 2 to 3 weeks from now, because, we really deliberated the entire day with our board and our stakeholder relationship committee, I think we are going to come out with a firm sort of a format and not be sort of, in the gray. And certainly we will reach out to all of you and update you. So I would say just bear with us a little bit more. It is actually this entire, I would say, deferment has happened because of the external environment, especially for HFCs. And believe you me, it is our endeavor to maintain liquidity, reduce gearing, be solvent. We are able to raise, liabilities, and within 15 to 20 days, I'm sure that we should be hitting the street, and our road shows will commence. We are very, very clear on that. It looks that probably the inflow of capital will not happen in this calendar year, but should certainly happen by February of 2020. We had very detailed discussions with all the board members, the 2 large stakeholders represent on the board, and it was a very empowered and I would say a very focused meeting that we had today.
What is the primary reason of the timeline changing from December 2019 to Feb 2020?
Well, basically it is that, because of the external volatility, we could not go to the market or reach out to the market being an HFC. And I think once, after Diwali, we again gather and we sort of, along with our BRLMs, we should have a very firm capital-based plan and we will hit the market in another 3 weeks' time. And we are sure that, we get commitments before we start doing our roadshows.
And so earlier expectation was that it will be preference capital. Now we should expect QIP, or it is still a preference?
Well, I would still say that, the format is not yet closed out, but to a guy like me, because we have a large FDI also which owns, a large stake in the company, and FDIs cannot participate. I think it is going to be a combo or a rights or a combo of two things like that.
So it may be a rights issue also?
Yeah, it can be.
And sir, on the margin front, even in this environment, without growing the corporate book, which is a larger, higher margin book, your margins are going up. How much of the core margins, excluding assignment, have gone up?
So basically, the core margin without assignment has gone up from 198 to 206. And I think that in quarter 3, it should climb up. That's my estimation. Don't hold me. It's not a forward-looking statement. It's just a guess of a product manager. Should go up between 11 to 12 bips more. Because the full impact of the reference rates, which we did change in June, will take about 105 days to come at a portfolio level. And I think we should be, bang on at about 13 to 14 basis points without the assignment income.
What is the current? Sorry, 213 basis points. That is what you're saying.
No, today it is the pure is 206.
206 is the spread, right? Not margins.
Is the spread? Is the yield on portfolio minus the cost of funds.
Right. So margin would be slightly high, would be north of 3.
Yeah, it is. The 350.
Core.
What do you mean by core?
Without the margin, NIM.
Yeah, the NIM is about is at 316. Yeah, it is there. We have given that.
That would be including margin assignment or without assignment?
Including.
Yeah, I was just asking without the assignment. Sorry.
Yeah, that is including.
Okay, sir. And what is the status of the 4 accounts out of the 5? One is NPL.
Okay, I'll give you details. So just to say, so 19% of the AUM is of corporate book, and CS is 12%, corporate term loans is 4%, and the LRD is 3%. The top 20 developers, they contribute to 62% of the book, right? Now coming to 4 accounts. Now one is IPL Gurgaon, which is an NPA of 111 crores, and the developer deposited 39 crores in this quarter, and that is how it came down from 150 to 111. The ECL provision is 37%, and we continue to work with the developer and expect to resolve this account by the end of the financial year. The second one is Supertech Gurgaon, which is stage 2, and the outstanding loan amount is 244 crores. The ECL provision is at 36%, and we are working towards ensuring remoteness to bankruptcy in this account. Once that is in place, the option is to get additional funds for the project, and we have also taken additional collateral on an exclusive charge basis to further secure our loan. Out of 16 towers in phase 1, 8 towers are in advanced stage of construction, in which 85% completed, and 80% is also sold. The third one is Ornate Mumbai. This is stage 1. The outstanding loan is 181 crores. The ECL provision is 32%. All approvals are now in place for additional FSI. Due diligence is being done by Shapurji Palanji to be a joint venture partner. Radius Group, Mumbai, stage 2. The outstanding loan amount is 259 crores. ECL provisioning is of 35%. Fresh evaluation of the project is completed. Requirement of additional funds has been identified. Work on project site has started with focus on completing the retail commercial area, which is majorly sold and has committed receivable. He is in talks with a private equity firm and a few financial institutions to fund incremental debt requirement. Then is an IDO waterfront, which is the Ludhiana project. This is in stage 2. Outstanding loan is 38 crores. The ECL provision here is small, and because our security cover is almost 6 to 7 times. The developer has offered structured payment plan and paid around 7 crores. We continue to work with the developer and expect to resolve this account by the end of the financial year. We have created specialized teams of skilled professionals of various streams and faculties to monitor, measure, and mitigate the increasing risk due to ongoing systemic environment.
Thank you, sir. Very comprehensive. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Piran Engineer from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi sir. Congrats on the quarter. I had a couple of questions. Firstly, what percentage of our deposits come from retail sources?
86% by value.
Okay, which means that our average ticket size is 6.5 to 7 lakhs per deposit?
No. Our average ticket size per deposit is about 1 lakh rupees.
But then, I mean, the math doesn't add up.
7 lakhs? Oh, okay. Oh, sorry, I'll stand corrected.
So it's 7 lakhs?
Yeah, it is 6-7 lakhs.
But how are we able to get such, high value deposits? Because our
you come join us, you will also do it.
No, that's fine, but like Bajaj Finance's average ticket size is probably half of that. And it's a similar sized book also, 2 lakh depositors, 16,000 crores of...
The thing is that is a customer profile and the way the brand has been positioned in the target audience. And our broker and our franchise network, our relationship managers, our service standards. I mean, you test us on the 36th minute of your SMS coming from your bank that your account has been debited. Your deposit will be there through a uni channel, whether you want it on email, you want a physical, you want at home, you want in office, you want at broker, you want in a branch. That is the type of automation, accuracy, dedication and service orientation backs our products, all our services.
Okay.
We have very predictable service standards.
Understood. That's good to know. So, secondly, why is our OPEX so low this quarter? Are there any one-offs or is it, it's just... For example, our other OPEX is down from 57 crores last quarter to 44. Even on a YOY basis, our overall OPEX is down while the book has grown. So, one is that, as we have been saying over the years, that this organization has been investing a lot of infrastructure, on technology, on skilling, on people development, on expanding the team, branch network, hub creation. Now, this is a year of consolidation. So you have started seeing the colors of our past investments, and you have started seeing optimization of capacity utilization. And I think, we are in a state where the expense on running the company has stabilized because, frankly speaking, there is no branch which has been added. On the technology side only, we are working on the wholesale or the corporate finance part because most of our digitization got completed. Most of our information security initiatives got completed. Our corp CPC is totally, digitalized. So primarily is that whenever a high growth company takes a little pause, the incremental costs don't add up. And if you have been following these earning calls of ours, I have been again and again saying that 30% of capital expense hits you in the same financial year as a revenue expense because of rent, rates, taxes, salaries, depreciation, AMCs, etc., etc. So that has not sort of, and that is why even in the previous earnings call, we used to bifurcate our OPEX into steady state and for capacity building. And that capacity building has actually stabilized, and we are optimizing the past capacities, and hence the OPEX is showing its colors.
That's true, but I mean, to be honest, you all have been, not opening branches for the last 3-4 quarters, but it's only in this quarter that there's a sudden dip. So I was just trying to get a sense.
Just a second. And that is what I keep saying, this is annuity business. Your costs will hit you first, your incomes will come with a lag. Even when our business incremental disbursements have degrown by 31%, our profits are very smart, right? Because whatever build-up we did in financial year 19 has a full year impact this year. And the lucky part is that we did smart business in Q1 and half of Q2, and in Q3 and Q4, the flow will start coming in.
Okay, let me put it this way. For every incentive that you all pay a sales employee for disbursement, do you all upfront that expense in the quarter, or is it amortized?
No, the incentives will always be amortized.
It will be amortized.
Upfronting will only be for the fixed salary. The variable component of salaries will be amortized for the life cycle of a product.
Makes sense. And sir, last question. When you mentioned that the run rate of disbursements for the rest of the year will be similar to 2Q, this is assuming that you all do not raise capital.
No.
The trajectory would pick up once you raise capital.
So let me be very, candid. Today, yes, we have a capital constraint. But the fact of the matter is that there has been so much of, I would say, apprehension in the sector. For example, you did not pick up on that line that when at an industry level under construction properties are 68%, we are only 21%. And this is not overnight that you can bring about this change. This change we have been bringing about ever since November of 17, when we said we were the first people to forecast that there is going to be a tightening of liquidity. Now, we could harbinger that on the supply side, the credit flow will get constrained. So we started sort of, be on the back foot even when we are doing retail under construction.
Okay, makes sense. Thanks a lot for, answering the questions, and all the best.
No, thank you. Have a nice evening.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So firstly, with the cost of funding going up and banks becoming very, very competitive, the spread between what the rates being offered by, let's say, Pnb Housing or other HFCs, we have seen very sharp difference between the rates offered by SBI and some of the other players. So do we think that the competitive positioning for a company like Pnb Housing has been weakened because of this, and only if market sentiments improve, we can be able to get funding at a competitive rates?
See, one thing is, okay, you complete your question, then I will start my answer.
And secondly, what we have also observed in the bond market that HDFC and LIC have been able to get funding, especially recently, at quite competitive rates. So what is the conversation that you are having with bondholders, and what is putting them, what is scaring them to give you money at the same rate or comparable rate to the likes of HDFC and LIC Housing Finance?
Okay. So the first thing is, we have never been competing with the large public sector banks on price. You would see that over the last 10 years, we have never advertised any of our loan asset products with a coupon rate. We right price our credit, and we have been doing it from day one. Yes, the arbitrage between our rates and the lowest rate has widened. We are not going to walk that path at all, even if my cost of funds is that low, because it does not make any business sense. The second thing is, as we said, we are basically we have created a differentiator now, demonstrated over the last 8 to 9 years, that we can acquire, underwrite, deliver with dignity, and manage self-employed individuals very well. And there the opportunity to price credit at our price points is still very smart. The opportunity to earn non-fund-based income is very smart. The opportunity to cross-sell fee-based products, third-party products, is very smart. And even after the portfolio getting tested by demonetization, by GST, by the current liquidity tightening, the portfolio is best in class. And if you were to see a securitized portfolio of almost 16,000 crores, which is 39 MOB, the gross NPAs are only 19 basis points. So that is the type of quality differentiator we bring at the right price. So we are not the discount masters of the sector at all, and we have never been, we will never be. And that is the firm conviction with which this management works. We right price our products. Right? So that is on that side. And that is why when it comes to resale properties and completed properties, we have an edge with our other players. Yes, the process of acquiring is very widely dispersed. It is rigorous. The process of delivery has to be very robust because the sale deed has to be done along with the transaction, and the perfection of mortgage happens on the day the disbursement check, the physical check is given. It gets honored later on, but the mortgage creation happens much before. And so that's about the competition, about our sort of segment specialization, our veracity, our tenacity, our robustness, our systems, our digitalization, etc. And we are very sure that with the advanced technology that we have across this company, we are going to further optimize, utilize. I will never use the word exploit. We don't never exploit any resource. And so that's about it. We are very confident. And the real estate developers also like us for that, because we bring in a new segment of customers to their table. That you start selling properties not only to salaried people, but also to self-employed people. And in India, 73% of new housing gets created by self-employed people. And they are only 23% penetrated. So it's a huge opportunity. There's a huge headroom to grow. So we are very confident. We never competed, even in days when our cost of funds were as low as anybody else. We never competed with the brand names that you took, right? And that is why we were able to grow, because we actually I would say, sized the market for formal sector lending. So that's what we have brought to the table as a nation builder, right? Now coming back to the bond market, well, yes, there have been a lot of, I would say, secondary market, I would say, dumping a little bit of our bonds at phenomenally high spreads. We have spoken to people. The beauty is that the same people also subscribe to our new bond issuances, and they like to, sell it in the secondary market at a discount. That's market dynamics. We are never going to do any buybacks. I'm not going to fall into that trap and snowball that effect. And I really wish I was wanting that large bond to come our way today or yesterday, but I'm very hopeful that very marquee NCD is going to come our way for a very extended term from a large marquee brand. And we are going to rub our shoulders with anybody and everybody.
Sure. And secondly, sir, on the corporate book, there have been a lot of concerns across the board. But as of now, the watch list that you have closed has also shrunk. There has not been any accretion to NPA. So how is the quality? Do you expect this watch list to change over a period of time? And any accounts which you think may get added to that?
So when we manage a portfolio, whether it is retail or it is corporate, there are forward flows, there are backward flows, there are stabilizations, there are normalizations. So that is the job of an annuity lender. So yes, I would say I would really wish that these 4-5 names get out, and if 1 or 2 come, so be it. And in the past also, when this entire fury of corporate finance was not there, it was not that there were no forward flows and there were no resolutions and there were no curing of accounts. So it's a continuous process, and unfortunately, this entire thing has blown out of proportion, and we welcome anybody who really wants to come and talk to Deepika, our head of investor relationship. We have an exhaustive list. If it was not for the Fair Practice Code, we were wanting to put it up on the entire portfolio on our website. But our capital market lawyers didn't agree to it last evening, and I was disappointed by my lawyers, and my team worked very hard on those all 168 accounts, and we can give you a PDF, but you will have to sign an NDA.
Yeah. And just lastly, just to add on one more question on corporate book, there is a perception in the market that some of the loans have been advanced at a much lower yield. And this is the perception which I have heard from some of the peers or some of the investors as well. So any comment on that or any?
Yeah. Are you done with your question? So, okay, the answer is, what is the definition of corporate finance or construction finance? A lot of people say we are not right pricing our credit. If you go on our website, we very diligently, transparently, in a truthful manner, disclose that all our construction finance loans are for resi projects where the land has been aggregated, consolidated, converted, plans approved, RERA registered, and formally launched. So stage 4 as we decide. Right? And if you see and you compare the pie of under construction of quarter 1 to quarter 2, you will also see the pie moving, and they are getting completed. Right? In that sort of a formal, and these are very, very marquee brands. And so this is a formal construction finance, and that is why the portfolio, we can talk about it so openly. We can, share everything. 94% is mass housing with marquee brands. Those brands, if they were to raise a bond or an NCD on their own balance sheet, can probably do it at a much lower rate. So it would not be very kind to say that we have not right priced our risk or our credit. So it can be the same developer, my dear friend. But what is that construction finance loan for? Is it for purchase of land? Is it for consolidation? Is it for aggregation? Is it for regulatory arbitrage? That is approval. So it all depends that where are you entering with what brand, what is the rating, what is your security cover, what is your debt service cover, what sort of governance, what quarterly monitoring are you doing, or you are just writing a single check and telling the developer, okay, you pay after 5 years. Here, utilization, sales velocity, collection efficiency, operational compliances, escrow compliances, litigations, everything. These are 5-6 virtues, and they have 7-8 attributes. A team of 45 people work quarterly to monitor what we agreed at our time of loan sanction and what is the reality. And we do this sort of RAG analysis with our red, amber, green, with our board every 6 months. So if our terms of reference are so stringent, obviously we will have to shave off a few basis points on the yield.
Yeah. And just two more questions on the data point. One is that fee income has not dropped that much versus the disbursement drop that we have seen in this quarter. So what is the reason for that? And secondly, the assignment spread, the assignment income as a percentage of loan assigned during the quarter has come down substantially over Q1 in this quarter. So
no, so one is the fee income has not come down as much as the disbursements have come down. Majority of the I would say degrowth in disbursement has happened on the corporate side. So on the retail side, the degrowth is only 11%. So that is one reason. The second reason is that the fee income also gets amortized. So there is a forward flow from the old loans also. So it would not be very, I would say, precise to make that comment that if your loan disbursements have fallen by 32%, why your fee income has not fallen. And what was the second part of the question?
Sir, assignment income as percentage of loan assigned within the quarter.
Yeah, because that spread is not as much as quarter one spread, because this quarter we did more of home loan PSF and not LAP. Last quarter we did a lot of LAP.
Okay, sir. Okay. That's it from my side, sir. Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from ICICI Securities. Please go ahead.
Sir, thanks for taking my question. So first,
Mr. Tibrewal, can you speak closer to the handset, please? Your voice is not audible.
Is it audible now?
Yes, sir.
Yeah. So, sir, I wanted to understand, within your corporate loan book, out of all the projects that you have lent to, how much of the exposure would be under moratorium now?
Yeah. Moratorium. Yeah. About half the book is under moratorium.
All right.
But it has moved from 67%. But it has moved from 67% to the current one.
Okay, so from 67% it's down to about 50% now.
Yes, and even during moratorium, principal moratorium period, if there is a healthy cash flow then anticipated, if the excess cash flow then anticipated comes for principal moratorium, for principal repayment, and in this first half of the year, 233 crores got repaid during principal repayment from these accounts, which were actually under principal moratorium.
Okay. And sir, what is the typical tenure of this moratorium? About 12 to 15 months?
Okay. Now, what happens is when you acquire a construction finance account, it also depends at what stage of construction you are acquiring the project. So if the project is acquired towards, let's say, 50-60% completion, the moratorium period will be shorter. But if a project is acquired at a nascent stage and construction is taking, let's say, 30-35 months, then the moratorium period will be around 30 months. So it all depends at what stage of life cycle of a project an account is acquired. So there is no, I would say, fixed thumb rule that 60% of door-to-door term will be moratorium and 40% will be for principal repayment. It is not like that.
Okay. And sir, out of those 4 corporate exposures which are under your watch list, are they currently all under moratorium now?
No, they are not. They are not. They have, like IPL, as I said, they have repaid 39 crores. Supertech has moved to repayment. Onet is at moratorium. Radius is in moratorium. Aereo Waterfront is in principal repayment.
Okay. All right. Thank you, sir. And sir, during your opening comments, I missed what is the retail GNPA and the corporate GNPA now?
Retail is at so this is at portfolio on balance sheet level,
Retail is 0.84 and corporate is 0.83. There's 1 basis point difference. At a portfolio level, since it is only 89%, the corporate book, you can say 84 bits.
Okay, all right. And so just one last bit. So out of the total retail disbursements, how much were disbursed into salaried and self-employed? If you could just broadly give me that split.
It would be about 60-40. 60 for salary, 40 for self-employed.
Okay. Thank you so much, sir, and all the best.
Thank you. Thank you.
Thank you. A reminder to the participants, please limit your questions to 1 per participant. If you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Ayushi Mota from CD Research. Please go ahead.
Good evening, sir. So what sort of disbursements amounting to around 850 crores have you made to corporates in H1?
Yeah. What? H1 850 crore disbursement, what sort of?
These are basically, construction finance loans where the projects are performing as per our stipulated guidelines, and these are partly disbursed loans where the demands have come.
But sir, why are we increasing our exposure to corporates?
It is not increasing, it's my commitment to disburse. These loans are already partly disbursed. If I stop credit on the supply side, these projects will never get delivered. And there are so many people who are waiting for their homes, so I would not be a good, I would say, creditor for the project. So if I have 168 projects, we are committed along with the developer fraternity to deliver about 74,000 units. I cannot strangulate the ongoing projects.
So sir, how much more is your commitment? Yes.
Sorry to interrupt, ma'am, but for any follow-up, request you to rejoin the queue, please.
No, but it's related to the same question. It'll just take a minute.
Yes, ma'am, I understand that, but as per the guidelines, you need to rejoin the queue, please.
Sure.
Thank you. The next question is from the line of Nischint Chawate from Kotak Securities. Please go ahead.
Hello? Am I audible?
Yeah.
Yeah, sure. I just wanted to get 1 or 2 numbers. What would be your stage 2 loans?
What is it?
He wants stage 2 loans.
For which stage 2?
So you have given stage 1 and stage 2 loans put together are around 73,700 crores. Just wanted a breakup as to how much of this is stage 2.
Well, they are retail loans. We have a retail base of 3 lakh customers. These are, under the Fair Practice Code, I cannot divulge the details of my customers, sir.
No, I just wanted a number in terms of so you give a breakup between stage 1, 2, and 3. So I just want
we don't give those type of breakups. Sorry.
Sure, no issues. Just a qualitative color, maybe of the 12,000 crores of.
Annually we will give. No, it is always in our annual report.
No, sure. I was just looking at a quarterly color, but that's fine. If it's not available. The other thing was, if I look at the incremental resource mobilization of around 12,000 odd crores. If would give a broad qualitative color in terms of, how much you have raised from banks, mutual funds or whatever, some breakup of that.
Most of it is from banks and mutual funds, is basically CPs. Banks has very smartly gone up in the beginning of the year from, I think, 16% to 22% plus deposits. NCDs have been lukewarm.
And the NCD issuance number that you are on an outstanding basis, if I look at the NCDs that you have, this would be largely with mutual funds or with some insurance as well?
Well, they are all mixed over with provident funds, insurance companies, mutual funds. It's a mix and match.
Okay, great.
Multilaterals, IFC, ADB.
Sure, great. Those were my questions. Thank you.
Thank you. The next question is from the line of Ronak Bora from AUM Advisors. Please go ahead.
Hi, sir. If you can provide the geographical distribution of your retail book, actually.
40, 30, 30, 40 is west, 30 is south, 30 is north. North also has east in it.
40 is south, 40 is north. 40 is north, right?
No, 40 is west.
40 is west and west is north.
The south is 40 is west, 30 is south, 30 is north.
Oh, okay, got it. Thank you.
Thank you. The next question is from the line of Mohit Mangal from CRISIL. Please go ahead.
So thanks for the opportunity. So the credit costs have gone up substantially in H 2020. So do you have any guidance for the full year 2020?
I think, see, what happened that, we had, one was obviously the tax reduction, and our portfolio behaved very well. Our spreads improved. So we had little bit of, I would say, luxury. We have over-provided, and it has moved from 48 basis points to 80 basis points. And I think on an annualized basis, it should stabilize at about 60 basis points.
All right, fine. Thanks a lot. Thanks a lot.
Thank you. The next question is from the line of Himanshu Kona from Morgan Stanley. Please go ahead.
Hello, this is Subramanian. Thanks for the opportunity. I just had a data question. If you could split the income on assigned loans into gross income and expenses attributed to the pool.
Gross and expense?
Gross income on...
It is income only. What is the expense?
So there would be essentially expenses that would be attributable to the pool that would be netted off, right?
Yeah, so there is also a fees. So they get nullified. So unamortized expense and unamortized fee on a particular amount when it is sold out, 90% will get upfronted and will get normalized. And the remaining spread will get front-ended, and about 20 to 25 bips we assign for servicing.
Yeah, so if possible to split that 110 crores...
Every pool will have a different dynamics. Because some will be self-employed, let's say, housing, some will be salaried housing, some will be LAP. So there is no thumb rule that I can tell you. Every pool has got different spread, has got different unamortized COA, has got different unamortized upfront fee.
Okay, got it. And the other question I had was also another data question. If you can provide the yields by product both on a book basis and incremental basis.
I think this is also on our website, no? This is not, okay, I'll just give you, you want the incremental?
As well as the on-book.
On book, it is basically... home loans are at 9.74, LAP loans are at 1088, construction finance is at 1277, LRDs are at 1036.
And these are annualized yields?
These are annualized yields.
Okay. And any sense of incremental?
Incremental, I will tell you, home loan is 983. LAP is 1039. Incremental CF is at 1236. And LRDs are 1020.
Great. Thanks a lot.
Thank you. We take the last question, which is from the line of Omkar Kulkarni, an individual investor. Please go ahead.
Yeah. When can we expect the appointment of the new chairman?
So that has to be approved by the Ministry of Finance. It has been sent for their approval. Once that comes, he will get appointed. The NRC has already approved his appointment. And it's just a matter of, I would say, formality.
Okay. And you said there is delay in capital raising because of external environment. Is it like everyone knows about the significant deterioration in the company's market capitalization? So is it more to do with that you are pushing the issue, or any other external factors you are talking about here?
No, it is more of external rather than anything to do internally. Internally, your company is very robust, as you are seeing, quarter on quarter. So I think, but we will have to be brave. We will find a sort of a solution in another 2 to 3 weeks, and we will hit the market.
Yeah, so that means it's nothing to do with the deterioration of the share of the company, the market capitalization?
No.
Because ultimately you have to shell out you will get less and it will be higher.
Obviously, but if the market cap is muted, the dilution of the existing shareholders will be more.
Yeah, so that's what I'm asking. So is it more to do with that or you are pushing?
No, it has nothing. It is nothing to do with that. The hesitation of the board is not because of the market cap.
Okay. Thank you.
Thank you. I now hand the conference over to Ms. Deepika Gupta-Padhi for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website, that is www.pnbhousing.com. Thank you.
Thank you. Good night. Thank you, folks.
Ladies and